Three important things I learned from experience in the stock market. Number 1, hold your winners. Many value investors will tell you to only buy a company when it is undervalued and sell it when it becomes overvalued. In my experience, the stocks in which I have made the most gains are the ones which have become overvalued due to valuation expansion. There are countless examples of this occurring. The biggest companies in the stock market have all gone through phases of being overvalued and undervalued. Yet, despite the change in valuation and sentiment over the long term, they have been proven compounders. The market rarely prices companies at their true intrinsic value. If there is strong sentiment surrounding a company, the market will bid it up to stupid valuations that value investors would call a bubble. One example of this is Palantir. Palantir is one of the fastest growing companies in the last few years, and the stock price has reflected that, increasing over 1,482.94% in the last 3 years. But its forward price to earnings ratio is now sitting at 96, considerably higher than what value investors would consider fair value. Likewise, stocks with very poor sentiment will get sold off to silly valuations that you wouldn't even think is possible. For example, Adobe, which is trading at a forward price to earnings ratio around 9 despite the company growing fairly strong. There are many stocks which I have made gains on more than I thought were possible and have sold early since I believed they were too overvalued. I'm looking at you, Palantir. However, if I had just held on to them, I would have made significantly more gains. Likewise, there have been so many that I could have sold after a 10% or 20% or even 50% gain, but held on to them, and now I'm sitting on over 300% in gains in both Broadcom and Comfort Systems USA. Number 2, buy as much as you can during broad market meltdowns. When there is a broad market correction, meaning the majority of stocks in the market are crashing, and everybody is panicking, don't wait around trying to time the perfect entry, because you'll miss the opportunity to buy great companies at multi-year lows that rarely ever comes. If you see attractive deals in the market, i.e. great companies dropping 20%, 30%, 40% plus, take that opportunity because you may not get that chance again. If you've been invested in the market this year, or during the Liberation Day turmoil last year, you would have realised this fact yourself. If you missed the best 10 days in the market, your returns will be significantly less than those who capitalised on the opportunity. The best returns I ever made in the market was from buying during the Liberation Day turmoil last year and the bear market of 2022. Number 3, if a company looks cheap, it doesn't mean it can't get cheaper. There are many stocks I bought because of what I considered were attractive valuations at the time, just for them to crash another 30% after I bought them. It's always best to consider this fact before you enter a stock with poor sentiment, as it could take months or years to recover, especially if it's been sold off into low teens or single-digit PE territories. When a stock drops so much, it's hard to believe that it could go even lower. You'll tell yourself that only the true value investors are still holding tight. But remember, most people in the market get impatient and sell before the turnaround ever comes. So when you buy a hated stock, just be prepared for the likely outcome that your holding drops significantly before it recovers, and that's if it ever does.